Hi, welcome back to Intermediate Accounting.
Today we're accounting for income taxes.
And listen to my mom, yeah.
From our last video and our last class, we discussed temporary differences, and they can be one of two types. Taxable temporary differences. Our taxable income is going to be higher in the future, so we set up a deferred tax liability. And deductible temporary differences, we're going to have tax savings in the future, so we set up a deferred tax asset. Let's look at specific situations that result in these deferred tax assets and deferred tax liabilities. There are four categories of items that can cause temporary differences. This category here is the result of our pre-tax income, our income under book purposes, being greater than taxable income because revenues or gains are recorded in pre-tax income in the current period, but will affect taxable income later. Here are some examples. Sales accounted for on the accrual basis. So we recognize revenues now, but we wait to include them in taxable income till we get the cash later. This means our taxable income is lower than our pre-tax income. So the amount of taxes payable this period are lower, but they're going to be higher in the future. And therefore we set up a deferred tax liability. Other examples, investments accounted for under the equity method and unrealized holding gains for financial reporting purposes. All examples of revenues without having the cash this period. We expect to get the cash in a future period. And then in that future period, we have to pay the taxes. So we set up this deferred tax liability. Let's take a look at another scenario. An example where pre-tax income is less than taxable income, and the reason is because expenses are recorded in this period. And those expenses are going to be paid off in cash in some future period. Because we don't have those expenses this period in taxable income, our taxable income is higher, and our income taxes payable are higher now. They're going to reverse out in the future, so our taxable income in the future is going to be lower, and therefore we set up a deferred tax asset. Here are some examples: product warranty liabilities and estimated liabilities related to discontinued operations or restructurings. What are the other side of these two entries? When you have a product warranty liability, we're recording the warranty expense. And here in item 2, we're going to be recording some restructuring charge this period without perhaps a cash payment sometime in the future. Litigation losses when we expect to lose a lawsuit, bad debt expense, stock compensation expense, and unrealized holding losses. These are all examples, again, of expenses or losses now under book income or GAAP income that we expect to eventually show up on our tax form later. So we record a deferred tax asset. Okay, so just to review, pre-tax income higher than taxable income because we have the revenues now. Pre-tax income lower than taxable income because we have expenses or losses now. Third scenario is when pre-tax income differs from taxable income because we have revenues recorded now under tax and revenues recorded later under pre-tax income. So if the revenue is recorded now, we're going to have taxable income that's greater than pre-tax income this period, but our future taxes are going to be lower as these differences reverse out. And so we would set up a deferred tax asset. The examples here: subscriptions received in advance rental receipts. We're getting the cash now under pre-tax income, but we're not recording the revenue. We record unearned revenue or the liability. Pre-tax income is higher because under tax code says when we get the cash now, we can record that revenue. Other examples: sales and leasebacks for financial reporting purposes, and prepaid contracts and royalties. Get the cash now, record the revenue later under book or GAAP. And finally, the fourth scenario for how pre-tax income can differ from taxable income The cost of an asset was deducted for tax purposes. So what are we saying here? Expenses, we call them expenses under GAAP, we call them deductions. So I'll use expenses in parentheses. We really call these deductions under tax. In the current period, our expenses or deductions are higher for taxable income than there are recognized in pre-tax income. Expenses are either not recorded or lower. And so if our expenses are lower under pre-tax income, our income tax expense on the income statement is higher than our taxable income this period, but that's going to reverse and we're going to have higher taxable income in the future, so we are setting up a deferred tax liability. And the biggest example that we're going to see is with depreciation. A tax code allows greater depreciation to be recorded up front for tax purposes, and then you're going to see under book. So you're going to see higher depreciation expense, really a deduction for tax, or lower taxable income now, reversing in the future. Just some terminology. When we first established the difference between the book and the book basis and the tax basis, we call that an originating temporary difference. And as it reverses over time, we call that the reversing difference. So far, all we've talked about were temporary differences. There are also permanent differences that can result between pre-tax income and taxable income, meaning they're never going to reverse. It's not just a timing difference. So we can be looking at items that revenues or expenses that enter into our pre-tax income on a book basis or GAAP basis, but never become taxable, or the reverse, items that revenues or cash received or deductions that can be taken on the tax form, but will never be a part of our GAAP income. Because permanent differences never reverse, we never set up a deferred tax asset or deferred tax liability. The biggest example, one of the most common things that we see in the real world, is as interest received on state and municipal bonds. So a company invests in state municipal bonds and then receives the interest on them. Well, that's interest revenue for GAAP. If you earn interest, that's interest revenue under GAAP. But tax code says you can specifically not record that as your taxable income for that interest revenue. So your taxable income would always be lower than your GAAP income as long as you're receiving interest on this. This is just a permanent difference. Other items that you might see in our class examples: proceeds from life insurance carried by the company on key officers or employees. That is going to be a revenue or gain on the income statement. That is, you'll see in our pre-tax income on our GAAP income statement, but it's that revenue is never going to be taxed for tax purposes. Likewise, premiums paid for those life insurance policies are going to be expenses and costs on the income statement under GAAP, but they're never going to be deducted for tax purposes. Also, fines and expenses resulting from a violation of law, of course, that reduces income for the shareholder, but from tax code, for tax purposes, the government says you are not allowed to take that as a deduction on your tax form. You will never get to reduce your taxable income by fines and expenses, and that will result in a permanent difference. A couple of differences that go the other way: items that are recognized for tax purposes but will never be included in US GAAP income statement, percentage depletion of natural resources in excess of their cost, and deductions for dividends received from US corporations. Let's take a look at an example. Zurich Company reports pre-tax financial income of $80,000 for 2020. The following items cause taxable income to be different than pre-tax financial income. Depreciation on the tax return is greater than depreciation on the income statement. Rent collected on the tax return is greater than rent earned on the income statement. And fines for pollution appear as an expense of $11,000 on the income statement. The company's tax rate is $30,000 for all years, and the company expects to report taxable income in future years. There's no beginning balance in any deferred tax asset or deferred tax liability. So what do we need to do here? We need to calculate taxable income based on this. We know pre-tax income. For each of these items, we say, how do we go from pre-tax income of $80,000 to get to taxable income? Do we need to add, subtract, or ignore each one of these items? As we're going through each item, we also have to ask ourselves, is it a temporary or permanent? Is that item temporary? If so, it's going to reverse in the future. And if it's temporary, we're going to need to establish a deferred tax asset or a deferred tax liability. And then finally, what we want to do is record the journal entry for income tax expense and income taxes payable. Let's get started on the next page, the next slide. Start with our book income or our GAAP income, which we're given as $80,000. Next, let's look at this excess tax depreciation. So we're told that on our tax form, our depreciation was $16,000 higher. So that depreciation expense was $16,000 greater on taxes than it was on book. So we do need to adjust for that. If we're starting from our book income, our pre-tax income of $80,000, are we going to add or subtract the $16,000? Well, our taxable income had greater depreciation expense, which means our taxable income was $16,000 lower. So we're going to subtract that. Now, depreciation is temporary. It reverses in the future. So this means our taxable income was lower by $16,000, but future taxable income is going to be higher by $16,000. And when future taxable income is going to be higher, we establish a deferred tax liability. Now, the deferred tax liability itself is not the full $16,000. We see here this column is deferred tax liability. We're going to, at the bottom, multiply this by the tax rate. This is the future taxable amount. To get from the future taxable amount to the deferred tax liability, we need to multiply by the tax rate. We're going to do that once we account for all of the differences, each of these three differences. Let's look at this second item, excess rent collected. Rent collected on the tax return is greater than rent earned on the income statement by $27,000. This means our taxable income is $27,000 higher than our book income. So are we adding or subtracting the $27,000? We are going to add that because our taxable income is higher. Is this, next question, is this going to reverse into the future? Absolutely. Most likely what happened is we received $27,000 in advance, and on the books we recorded a debit to cash and a credit to, a debit to cash and a credit to unearned revenue. This rent we're going to earn over time in the future, and we're going to earn it in the future. So right now our taxable income is $27,000 higher, but in the future our taxable income will be $27,000 lower, which means that we're going to have future tax savings. So we're going to record that as future tax savings. And then once we multiply it by the tax rate, that's going to give us the amount of our deferred tax asset. The only reason that we're not doing the calculation here, right in this cell, 27,000 times 0.3, is because we have one more item here. And we're generally going to take care of all of these specific future tax savings or future tax amounts owed, sum them up, and then multiply it by the tax rate to get our deferred tax asset and liability. The fines we see here, they're told to us that this is permanent. That is always the case. Fines for pollution appear as an expense of $11,000 on the income statement. Because it's permanent, we don't need any deferred tax asset, or there's no future taxable amount, no future deductible amount. How do we adjust to get from the $80,000 of pre-tax income on the income statement down to taxable income? We know the amount is $11,000. Are we adding or subtracting the $11,000? Well, we reduced pre-tax income by $11,000, but we need to add that back because we cannot take that as a deduction on our taxable income. So taxable income, start with our GAAP income of $80,000, then subtract $16,000, add $27,000, and add $11,000. Taxable income is $102,000. Multiply that by the tax rate of 30%. And this gives us our income tax payable of $30,600. Our total deferred tax asset on all of our items is $27,000. Multiply that by 30% to get our deferred tax asset of $8,100. Our total future taxable amounts is $16,000. Multiply that by the tax rate of 30% to get our deferred tax liability amount of $4,800. Next, let's record the company's journal entry for income tax expense, income taxes payable, and the necessary deferred tax asset and liability account. We start with our debit to income tax expense. And in the last class, in the last video, we said we could simply take our pre-tax income, in this case $80,000, multiply it by the 30% tax rate to get our income tax expense. But we need to make an adjustment here. We have to adjust pre-tax income or book income or income before taxes. This is our GAAP number for any permanent differences because they're not going to reverse. When we're calculating income tax expense. So we're not simply going to take the $80,000 and multiply it by 30%. We're going to take the $80,000 and say that includes an $11,000 expense for GAAP purposes that's never going to reverse. So let's add that back. And let's multiply that $91,000 by the tax rate of 30%. And we'll get income tax expense of $27,300. We said that we needed to record a deferred tax asset of $8,100. And we need to record a deferred tax liability of $4,800. This $8,100, of course, was the $27,000 that we recognized in taxable income. That's going to cause future taxable income to be lower. And we said the $4,800 was the result of the excess tax depreciation that caused our taxable income to be lower by $60,000, but it's going to give us tax savings in the future. And finally, we're going to record income taxes payable, the amount that we actually owe to the government. And we solved for that amount by starting with our book income and making our three adjustments. We got taxable income of $102,000 multiplied by the 30% tax rate gave us income taxes payable of $30,600. What about when tax rates are expected to change in the future? A company must consider presently enacted tax changes, estimates to changes in the taxes in the future when they're looking at how temporary differences will reverse. Let's take a look at an example. Magnetics Company has a cumulative temporary difference related to depreciation of $580,000 at December 31st, 2020. Now, when we see the cumulative amount of the depreciation, we can always assume taxable income was lower than pre-tax income in the current period. And that's going to reverse, causing future taxable income to be higher in the future. This difference will reverse as follows: 2021, $42,000, 2022, $244,000, 2023, $294,000. Enacted tax rates are 17% for 2021 and 22, and then we're expecting the tax rate to go up to 20% for 2023. So now basically we need to make an adjustment. We can't just add up all of these three numbers and then multiply it by one tax rate. We have to look at what is the impact with the tax rate. So we have year 2021, 2022, and 2023. We have these future taxable amounts, which is going to give rise to a deferred tax liability. Once these differences reverse, give us higher taxable income in the future. So in 2021, it's $42,000, and we're multiplying it by the tax rate of 17%. We're using this to solve for our deferred tax liability, $7,140 in year 2021. We take the amount 244 and multiply it by the tax rate expected to be in effect in 2022, giving us a deferred tax liability balance of $41,480. And in 2023, 294, and we apply the rate that we expect to be in effect at that time of 20%. And this gives us our total amount. We're summing up these three future reversals, deferred tax liabilities, to get a total balance in deferred tax liability of $107,420. And what about when a tax rate actually does change? A company reports the effect as an adjustment to income tax expense in the period of change. And let's take a look at one quick example. At December 31st, 2020, Fell Corporation had a deferred tax liability of $340,000. That resulted from future taxable amounts of $2 million and an enacted tax rate of 17%. In May 2021, a new tax act is signed into law that raises the tax rate to 2020 for 2021 and any time in the future. Prepare the journal entry. So this is assuming that this was a brand new act, we weren't able to estimate it in advance like we did in our last example. Now we're saying we have brand new information. What do we do with this? So if we know that we're going to need to owe more because of the increase in the tax rate, we're going to increase income tax expense by the future taxable amount of $2 million multiplied by the increase in the tax rate. So it's going to go up 3%. We're going to owe 3% more. So 3% times 2 million, income tax expense goes up 60,000, and the deferred tax liability is also going to go up by 60,000. And that concludes this second part of the income taxes payable material.